You're sitting at your desk doing the thing you've been told to do since your first real job, checking your 401k. And you scroll past the usual suspects, a target date fund with a name like 2055 Retirement Freedom Portfolio, some bond thing you don't remember selecting, maybe an S&P 500 index fund. And then you see it in the news. Nvidia, the stock that went from $150 to over $900 in less than 2 years, the company that basically owns the AI revolution, just announced a 10-for-1 stock split. And your first thought is probably the same thing everyone's financial advisor has been telling you for years: stock splits don't matter. It's just cosmetic. It's like cutting a pizza into more slices, you don't have more pizza. And that's true. Technically. Mathematically. Objectively true. Except Sarah, who's 34 with $127,000 in her 401k, just watched that split happen and suddenly realized she could finally buy Nvidia in her retirement account. Not because the company changed. Not because the value changed. But because the number changed. And that number, that arbitrary cosmetic meaningless number, had been quietly locking her out of one of the best performing stocks of the decade. And when she went digging into why, she found something that nobody had ever explained to her, something that's been silently shaping who gets wealthy in America and who just gets average returns. My name is, your name, this is Profit Mindset, and today we're not really talking about Nvidia. We're talking about the velvet rope in your retirement account that you didn't know existed, and why that rope just got moved. Here's the thing most people get wrong, and they get it wrong in a way that quietly costs them real money over decades. When a stock splits, you think it doesn't matter because the value is the same. And you're right. But you're also completely missing the point. Because here's what actually happened when Nvidia split 10-for-1 in June 2024. The stock was trading at around $1,200 per share, which sounds like a lot until you remember that Berkshire Hathaway Class A shares trade at over $600,000 each and nobody blinks. After the split, each share became 10 shares, and the price dropped to around $120. Same company. Same ownership stake. Same everything. Except for one absolutely critical thing: Sarah could finally buy it. Let me introduce you to Sarah properly, because Sarah is about to spend the rest of this video discovering that her retirement account has been playing a different game than she thought. Sarah is 34. She works in marketing, makes about $82,000 a year, which is solid, genuinely good money. She's been contributing to her 401k since she was 26, doing the responsible thing, hitting that employer match, incrementing her contribution every time she gets a raise. She's got $127,000 saved. She is, by every measure, doing it exactly right. And for years, Sarah watched Nvidia climb. She watched it become the face of AI. She watched it go from a gaming graphics card company to a trillion-dollar giant. And she wanted in. Not with some fun money brokerage account, she wanted it in her retirement account, the serious money, the long-term fortress. But here's what Sarah discovered when she logged into her 401k portal and tried to buy Nvidia at $900 a share. She couldn't. Not because it wasn't available. Not because her plan didn't allow individual stocks, it did. But because her 401k was structured in a way that most people never look at and fewer people understand. Her plan offered something called a self-directed brokerage window. Fancy term. It basically means, you can buy individual stocks, but only full shares, and oh by the way, you can only allocate money in specific increments. So Sarah's sitting there with, say, $3,000 she wants to move into Nvidia. At $900 a share, that gets her 3 shares. With $300 left over that just sits there. In cash. Doing nothing. Or gets awkwardly reallocated back into that target date fund she's trying to escape. And Sarah thinks, okay, annoying, but fine. I'll buy 3 shares. Except her plan has a different rule. Minimum purchase, $2,500 per position. Or maybe it's 5 shares minimum. Or maybe there's a transaction fee of $25 per trade that makes buying 3 shares of anything idiotic. Every 401k plan has its own slightly different torture device. But the result is the same: when share prices get high, normal people with normal account balances get quietly locked out. Meanwhile, her coworker David, who has a regular brokerage account at Fidelity, just bought 2.73 shares of Nvidia at $900 because fractional shares are a thing in the regular world. He didn't need $4,500 for 5 full shares. He just bought exactly what his $2,457 could get him. Down to the penny. Same company. Same day. David's in. Sarah's out. Not because she had less money. Not because she was less informed. But because the architecture of her retirement account has a velvet rope that David's account doesn't. And then Nvidia split. And overnight, that $900 share became 9 $100 shares. Well, $120 post-split, but you get it. And suddenly, Sarah's $3,000 could buy 25 shares. No weird leftover cash. No minimum purchase anxiety. The velvet rope moved. Now, you might be thinking, okay, but her coworker David with the brokerage account could already buy it. So what changed? Great question. Let me show you the thing nobody draws for you. The real story isn't about Sarah versus David. It's about Sarah versus everyone else with a 401k. Because here's the genuinely wild statistic: there's over $7 trillion sitting in 401k accounts in America. Trillion. With a T. And the overwhelming majority of that money, we're talking 75 to 80%, is sitting in target date funds and index funds that people selected once, maybe twice, and never touched again. Not because people are lazy. Not because they don't care. But because the interface, the rules, the structure of most 401k plans makes active stock picking annoying at best and impossible at worst. High share prices are just one layer of that rope. But it's a layer that suddenly became very visible when Nvidia split and millions of people like Sarah realized, oh, I could actually do this now. So let's talk about the machine itself. Because if you don't understand why 401k plans work this way, you don't understand who this system was actually built for. And I mean that almost literally. Your 401k is not designed for stock picking. It's designed for passive accumulation with maximum legal protection for your employer. That's it. That's the whole design philosophy. See, when your company offers you a 401k, they're not doing it out of pure generosity. They're doing it because the tax code rewards them for it, and because employees expect it. But every single stock you pick inside that 401k is a potential liability. What if you pick a bad one and lose everything? What if you sue? What if you claim the plan didn't offer good enough options, or charged too much in fees, or didn't educate you properly? So the system is built with guardrails. Lots of them. High minimums. Transaction fees. Limited windows for trading. Mandatory settlement periods. Restrictions on how often you can move money. And yeah, often no fractional shares. All of this exists to keep you in the slow lane. The index fund lane. The you can't hurt yourself too badly lane. Which is actually pretty paternalistic when you think about it, but here we are. Meanwhile, in a regular brokerage account, you can buy 0.83 shares of anything at 3 a.m. in your pajamas and nobody blinks. Let me give you the framework that makes all of this make sense, and once you see it, you can't unsee it. Picture your retirement money as living in one of two worlds. World 1, the fortress. That's your 401k. High walls. Amazing tax benefits. Employer match. But also, strict rules, limited options, and you can't touch the money without penalties until you're 59 and a half. This world was built in 1978 to replace pensions, and it still thinks like 1978. In this world, stock splits actually matter because the infrastructure is old and clunky. World 2, the Wild West. That's your regular brokerage account. Total freedom. Fractional shares. No minimums. Trade whenever. But also, no employer match, no tax deduction, and if you make money, the IRS is right there with its hand out for capital gains. Same stocks available in both worlds. Completely different access. And here's the part that breaks people's brains the first time they really think about it: the money in World 1 is your money. Legally. It's your account. Your contributions. And yet, you have way less control over it than the money in World 2. Why? Because the government gave you a tax break to put it in World 1, and in exchange, you play by their rules and your employer's rules until you're old enough to collect Social Security. So when Nvidia was trading at $900, Sarah's money in the fortress couldn't efficiently buy it. David's money in the Wild West could. And that gap, that tiny structural difference, is part of why wealth inequality isn't just about how much you make, it's about where your money lives and what that location allows you to do with it. Now let's run Sarah's actual numbers, because so far I've been hand-waving and you've been politely nodding, and that's no way to live. Sarah has $127,000 in her 401k. Let's say she wanted to allocate 10% to Nvidia back when it was at $900. That's $12,700. At $900 per share, she could buy 14 shares. That's $12,600. She's got $100 left over. Okay, annoying but survivable. But wait, her plan charges a $25 transaction fee per trade. So she's really paying $12,625 to get $12,600 of stock. Whatever. Fast forward a year. Nvidia runs to $1,200 pre-split. Her 14 shares are now worth $16,800. She's up $4,200. Nice. But here's the thing Sarah didn't get to do: she didn't get to dollar cost average in. She couldn't buy a little bit every month as the stock climbed because every trade cost $25 and her plan had that minimum purchase amount. So she bought once, held, and hoped. Meanwhile, David in the Wild West bought fractional shares every 2 weeks as part of his automated investment plan. No fees. No minimums. Just steady accumulation. He caught dips Sarah couldn't access and built a position twice the size of hers with roughly the same amount of capital over time. Same stock. Same time period. Different infrastructure. Different result. And then Nvidia split. Post-split, that $120 share price means Sarah can now buy monthly if she wants. $500 gets her 4 shares with only $20 left over. Totally manageable. The friction just evaporated. That's what I mean when I say the split changed retirement accounts. Not because the value changed, it didn't. But because the access changed. Let me tell you about Michael, because Michael is the cautionary tale that still haunts the financial advice subreddits. Michael was 29 in early 2023. He'd been watching Nvidia since it was $150, kicking himself for not buying in earlier. But he told himself, it's too expensive now. I'll wait for a pullback. Or better yet, I'll wait for them to split the stock and then I'll buy. Sound logic, right? Except Nvidia never really pulled back. It went from $150 to $300. Michael waited. $300 to $500. Michael waited. Then $500 to $900. And Michael kept waiting because surely they'd announce a split and the price would come down and he'd get his entry. They announced the split in May 2024 when the stock was around $950. Michael celebrated. "See? I knew it. Now I'll wait for the split to actually happen and buy at the lower price." The split happened in June. The stock opened post-split at about $120, which, remember, is the same as $1,200 pre-split. And here's the cruel part, the stock kept climbing. It hit $140 post-split within weeks. Michael had been waiting for a stock split to make Nvidia affordable. But the split didn't make it cheaper. It just made the number smaller. And in the meantime, he missed a 700% run because he confused price per share with value. If Michael had just bought $5,000 worth at $150, he'd have had 33 shares worth $40,000 by the time of the split, which became 330 shares post-split. Instead, he bought $5,000 worth at $140 post-split and got 35 shares. He waited 2 years to get basically the same number of shares he could have gotten immediately, and missed the entire run. The lesson Michael learned, and it's seared into his brain now, is that stock splits don't create buying opportunities. They create psychological permission. And if you need permission from a number to invest in a company you believe in, the number was never the problem. Okay, let's zoom out because I don't want you thinking this is just about Nvidia or just about 401k quirks. There's something bigger happening here, and it's quietly rewriting the rules of who builds wealth in retirement accounts. For most of investing history, high stock prices were a feature, not a bug. Berkshire Hathaway famously never split specifically because Warren Buffett wants to attract long-term serious investors, not day traders. A $600,000 share price is a velvet rope that says, "This isn't for tourists." But the rise of fractional shares in regular brokerage accounts over the last 5 years completely changed that equation. Suddenly, Robinhood and Fidelity and Schwab let you buy $10 worth of Amazon or Google or whatever. The velvet rope came down in the Wild West. But it stayed up in the fortress. In 401k land, fractional shares are still mostly unavailable. Some plans have started offering them in the last year or two, but the vast majority? Nope. Full shares only. And that means millions of people with the bulk of their investable assets locked in retirement accounts are still playing by 1978 rules while the rest of the market moved on. The Nvidia split didn't just make the stock more accessible. It revealed that there are two parallel investing universes, and most people's serious money is trapped in the slower one. So where does this actually go from here? Let me lay out 3 honest scenarios, because anyone who tells you they know exactly what happens next is selling something. Path 1, the modernization. More 401k providers start offering fractional shares. The big players, Fidelity, Vanguard, Schwab, have the technology. They've already built it for brokerage accounts. Rolling it into 401k platforms is just a product decision. In this world, 5 years from now, Sarah doesn't even notice when stocks split because she can buy $500 of anything, anytime. The fortress starts looking more like the Wild West, and stock splits become genuinely irrelevant. Path 2, the status quo. Nothing changes. Employers don't demand fractional shares because most employees don't know to ask for them. 401k providers don't offer them because there's no competitive pressure. The fortress stays the fortress. And stock splits continue to matter enormously for retirement savers while everyone keeps repeating, splits are just cosmetic, like a mantra that's technically true but practically useless. Path 3, the bifurcation. This is the one I'd actually bet on. Some plans modernize. Others don't. And wealth inequality quietly widens along that line. The people whose employers offer Cadillac 401k plans with fractional shares and low fees build diversified portfolios with high-growth stocks. The people stuck in legacy plans with high minimums and transaction fees stay in target date funds and watch from the sidelines. Same tax benefits. Completely different outcomes. It's not dramatic. It won't get a news segment. But over 30 years, it compounds into hundreds of thousands of dollars of difference. So what do you actually do with all this? Let me get practical, because I don't want to just hand you anxiety and walk off. First, check your 401k's actual rules. Log in right now. Find the self-directed brokerage option if it exists. Check, can you buy individual stocks? Are there transaction fees? Is there a minimum purchase amount? Can you buy fractional shares? Most people have no idea what their plan actually allows. Sarah didn't until she tried. Second, know your mixing strategy. If your 401k is clunky but has a great employer match, max the match and put it in low-cost index funds. Then use a Roth IRA or regular brokerage account for your individual stock picks where you have full control and fractional shares. You don't have to pick one world. You can live in both. Third, stop waiting for splits. If you believe in a company, buy what you can afford now. Whether that's one share, half a share, or $50 worth. The split doesn't make it cheaper. It just makes the number look friendlier. And friendly numbers don't beat starting early. Fourth, understand the real cost of high share prices in your 401k. If you've got $10,000 to invest and a stock is $1,000 per share with a $25 fee, you're paying 0.25% in friction. Annoying but survivable. But if you're trying to invest $1,000, that's a 2.5% haircut right off the top. That's brutal. High share prices hurt small, consistent investors the most. And then there's the big emotional piece, and I need you to really hear this because it's bigger than any single stock or account structure. You've been told your whole life that retirement accounts are the responsible place to build wealth. Max your 401k. Get that match. Set it and forget it. And that's not wrong. It's just incomplete. Because the people who built those rules built them in an era when pensions were dying and index funds were the cutting edge of innovation and nobody had ever heard of fractional shares or apps that let you buy stock with your spare change. The world moved on. The technology moved on. But the 401k infrastructure is still mostly running on architecture from the 80s and 90s, with rules written by lawyers terrified of lawsuits and employers who just want to check a benefits box. If you're sitting there right now feeling frustrated that your retirement account won't let you do things your regular brokerage account does easily, you're not crazy. The friction is real. The limitations are real. And here's the thing nobody says out loud, you're allowed to be strategic about where you put your money. Just because the 401k has tax benefits doesn't mean every single dollar of your investing life has to flow through it, especially if your plan is a bad one. Do this instead, contribute enough to get the full employer match, that's free money, don't leave it. Check if your plan is actually good, low fees, decent options, maybe fractional shares. If it's great, use it heavily. If it's mediocre, get the match and then focus on IRAs and taxable accounts where you have control. There's no trophy for forcing all your investments through a clunky interface just because it has the word retirement on it. Sarah figured this out the hard way. After the Nvidia split, she did the math. Her 401k had high fees, limited options, and made individual stock purchases annoying. So she restructured. She contributes exactly enough to max her employer match, that's still the best return she'll ever get. But her additional savings? That goes into a Roth IRA where she has total control, fractional shares, and no transaction fees. She bought Nvidia post-split in her Roth. She's dollar cost averaging monthly. And yeah, she gave up a small tax deduction by not maxing her 401k, but she gained something more valuable, optionality. The goal was never to have the biggest 401k balance. The goal was to be free. And sometimes freedom means building wealth outside the fortress, even if the fortress has better tax treatment. Let me zoom all the way back to where we started. That $120 Nvidia share post-split looks like a totally different thing than the $1,200 share pre-split. It feels accessible. Affordable. Like something a regular person can own. But here's the truth the market doesn't want you to internalize: it was always accessible. The value didn't change. The company didn't change. The only thing that changed was the number. And the number only mattered because the infrastructure of your retirement account was built in a different era. The split didn't create opportunity. It revealed that the opportunity was always there, just hidden behind a velvet rope made of outdated rules and psychological barriers. And now you can see the rope. You can see that fractional shares exist in one world but not the other. You can see that high share prices are only a problem in accounts that force you to buy full shares. You can see that stock splits matter enormously in the fortress and barely at all in the Wild West. And the people who can see the rope are the only ones who ever figure out how to step around it. As for Sarah, last I checked, she's got 18 shares of Nvidia in her Roth and a plan to keep adding monthly. She stopped waiting for the next split, stopped feeling intimidated by share prices, and started actually building the portfolio she wants. Not because Nvidia split the stock. But because the split made her ask the question, wait, why couldn't I do this before? And once she went looking for the answer, she found the whole machine. So here's my challenge to you: go check your 401k rules this week. Actually open the portal. Find out what you're really allowed to do. And if the answer is, not much, don't just shrug and accept it. Build your wealth somewhere you have control. The retirement account isn't the goal. Freedom is. And sometimes the path to freedom runs around the fortress, not through it. Thanks for watching Profit Mindset. If you want me tracking this stuff as it happens, the splits, the rule changes, the infrastructure shifts that actually matter for your money, I break it down every week. No countdown timer, no fake urgency. This video is the demo. If this way of explaining things helps you see the machine, that's what you get every week. Now go find your stocks. Just make sure you've looked at the rope first.